Tom, great to see you.
You as well.
Welcome to sunny 2022. Looks like you got sunshine happening over in your neck of the woods.
Yeah.
We've got gray skies here. It's not that great.
Oh.
But it's okay. Hopefully
we're together.
COVID's safe.
That's all that matters, right?
Everybody's good. Yeah, exactly. This is a bit of a primer for a number of our fintechs that come to us and say, hey, I've got this amazing idea. I promise it's fantastic. It's going to be amazing. No one's ever done this before. How do I get it funded? And you and I have worked together in various ways and got to know each other since 2014. Is that right? 2015, something like that. And have looked at lots of different investments and things like that. And what I wanted to do is help give folks watching the show a little bit of updates on how to approach it. What do you think about fundraising and that sort of thing? Totally dynamic, lots of Q&A, jam on stuff. But before we get there, do you want to give us a little bit of background on you and when you started building and how you decided investing was your thing? What changed?
Well, so I have a very, very long arc in that I started, my first job was in the Valley when I was just a kid. Literally, I left Canada and came down to the Valley when I was 15 years old, working full time. And was actually hired away to started in product and built a couple of companies for very rich people that had more money than sense probably to hire a kid, and kind of .comified their ideas in the first .com boom. And one of those guys, a multi-billionaire, had then said, I want to allocate capital to other startups, and I want your help in doing that. So I was there for the entire inflation and burst of the first .com bubble, and then built a few different startups through the 2000s. And when I started my last startup in 2013, 14, right around the time that we met, I was very clear that I understood that Silicon Valley and generally our industry, regardless of geography, your social capital and network capital actually matter way more than your financial capital. And so as I was building my last startup, I wanted to really hyperscale my network. And I realized that the best way to do that was to be an angel investor, because that way I was interacting with other investors and trading ideas and deals and so on. And that really became kind of hyper scaled in and of itself. Like the amount of capital that I had budgeted, grew way more than what we had thought. And I realized it was actually the second date of my second child, who was born in 2015, but a year after he was born, a couple of years into Better Company, my wife said to me, look, you're miserable running this company, right? The thing that's supposed to be creating all this next generation of our wealth, you're miserable doing, managing other people, but yet you're totally animated, even though many of these companies, especially even when you might be losing our money, you're like totally animated and excited to be walking with that entrepreneur through that difficult time. And she said, you should really pay attention to where you're happiest and where you're living your purpose. And that was really investing. And so when we were able to sell Better Company in 2017, I started investing full-time in 2018. And I deploy more capital than most VCs do. In a year, I'll invest probably 25 to 30 million of that in a year, although I don't charge management fees on capital that I have under management, which means that I'm way more aligned to the entrepreneur because I only make money when the entrepreneur exits, as opposed to the management fees that many VCs make millions of dollars a year off of, that really we don't talk about in an industry how poorly aligned or misaligned the incentives are between entrepreneur and investor. So today I invest full time, and I'm really a formative pre-seed investor. I'm super grateful that you and the team actually introduced me to AK Patel of LendSmart, which we invested in the last year. And Chat sends me an email, some of your most promising, kind of partners in the ecosystem. And I look at every one of those that come in. So excited to talk about fundraising and try to kind of maybe outside of, VC Twitter, which I think is so terrible, hopefully give some real advice and real demystification of the process.
What did you think was the craziest funded startup in .com?
Oh, I mean, the funny thing is that all of those crazy ideas, the stupidest one was it was a nursery. It was a family-owned nursery, like plant and garden nursery. And they were like, we want to sell our plants online, which, makes sense. But like, to be a startup selling petunias and, just the economics of that business made no sense. And I remember they were like, in our first meeting, they're like, look, we have 2 term sheets already off of their business plan for their .comification of their nursery, one at like 40 pre and another at 60 pre. And they're like, if you don't decide to participate like in this meeting, then you're out. I'm like, that's just okay with me. And I knew like at that point, right. And huge Super Bowl ads, that we were close to, this could not be sustained.
How do you think it's different to today then? So FinTech is kind of pretty liquid, let's say.
Yeah.
And there's all different sorts of people offering money for all different sorts of ideas. What's substantially different between, or what would make you not fall into that trap of .com if you're a FinTech founder?
Right. And
today?
I mean, remember, other than that stupid idea, almost everything that was pitched back then is now a really big business. Right. And so, it's all.
Even Webvan, right?
Right. Even Webvan. Right. I mean, so I think everything is real now, or most everything is real. And I was talking about it with another friend of mine just late last year, and I really feel like we're still in the absolute early innings of software driven, eating the world in every respect. There's still so much paper, especially in FinTech. There's still so much manual stuff, especially in FinTech. There's still so many silos that have to connect to each other that have no business needing to be disparate, and so there's huge opportunities still. And so it's a really, really exciting time to be an investor. I think that what one has to realize is that, and I think like the starting point that I think is really important for people to know is that venture capitalists, which, even though I'm not by incentive structure, I think like a VC, unfortunately. And that's that when you get a company like Synctera and the revenue run rate from 0 to where we are today and where we'll be at the end of the year and where we'll be 3 years from now, when you have the pleasure and privilege of investing in companies that really can show you a scale to $100 million in revenue in just a few years, everything that you invest in has to be that big. Otherwise, it doesn't feel right. And so, what ends up happening is if you think about an average VC and assume that they have no principals, no associates, just them, right? Most VCs that somebody's pitching has a team. So just the partner. Let's assume conservatively that you take the math, right? 4 meetings, 5 meetings a day. Let's say 5 meetings a day, 25 meetings a week. When they go into their partner meeting and they socialize the best ideas that they have the most conviction in, they're probably only talking about 2 of the 25, right? And one of those is going to die right on the floor because the partnership goes, no way, we did that a few years ago, it didn't work, whatever the case may be. So that deal, unless something changes massively about that opportunity while they're still fundraising, is dead, right? The partner has no incentive to tell the entrepreneur that they're not going to invest in that company because they're waiting to see if something does change. But then again, that happens for 3 other weeks in the month, and in that partnership, they're going to do one of those investments that has survived, right? 1 of 4 or 1 of 6. So as an entrepreneur, what you have to realize is that you only know your company. Right. But an investor, anytime that they're evaluating your company, they're looking at 100 different opportunities that they're comparing. And so you have to be the thing that they feel like if they don't invest right here, right now, the next time that they look at this investment opportunity, if ever they get the opportunity again, it's going to be, the valuation is going to be 10 or 20 times greater than where they're investing. That's a bit of an exaggeration, but not by much. And so what I see entrepreneurs doing all the time is they think to themselves, well, there's so much capital out there and I hear about all these big deals getting done. Why is my deal not getting done? Well, the answer is because it doesn't look as exciting and big as the other things that investor is looking at.
That makes sense. Why should I actually fundraise at all? If I can afford to pay for it myself, should I do that?
You shouldn't. I mean, there's so many, so most investors who, who have a majority stake in your business, right? Who are heavily concentrated, owning 10% or more in your investment, in your company. They have a very strong point of view about what you should, how you are performing, what you should be doing, the decisions that you're making. And suddenly you've brought in this other person, right? That may have actually, even though they have opinions, that they may not be informed in any way and kind of fact or kind of, experience. And yet these opinions have to be immediately treated as if they're serious, right? And if they're equally as weighty as your own opinions. So, as many people have said, an investor relationship is actually way more intense and more of a commitment than a marriage. Marriages are relatively easy to get out of. You cannot easily get rid of an investor on your cap table. And then the other part of it is if you're taking money from, the kind of the small cadre of venture capital funds that are all connected to each other, they all talk, right? And what's weird is how many, even seed funds, will actually talk down their portfolio, right? And they'll be like, yeah, I don't think that's going to really work that well, and I kind of regret making that decision. They'll hype a few, but a lot of them, they really will either say nothing about, or they'll actually, kind of talk negatively behind the entrepreneur's back. So the entrepreneur comes to market for their Series A, and they don't even know the amount of negative, gossip and how much is already kind of conspired to work against that fundraise because of what other investors have already said. So, you should really only take venture capital from institutional venture investors if you think that you are heading towards, a several $100 million exit at minimum, and really multi-billion-dollar company. I mean, I talked to a company that you guys introduced me to last week or last month, and it was very clear that they shouldn't take somebody like my capital, right? Like they wanted to make a $50 to $80 million return, and they will for sure. I think they can make more than that. But like if you're in your mind of like, oh man, $50 million would be a game changer, which it should be. One of my entrepreneurs, second time entrepreneur, he had an acqui-hire offer from Uber that was like $30 million. It would have been a 2 or 3x return for investors, but they turned it down. They prevented him from taking the offer. And 6 months later, the company was sold for like cents on the dollar. So, I mean, and you and I know these stories are far more abundant than the good times, that we hear in TechCrunch.
Yeah.
And so,
how should I think about the stage of investor? So like you and I have done a couple of pre-seed things. You're a pre-seed investor in Synctera with me. You that's your sweet spot.
That's my sweet spot. There's most people that say they do pre-seed don't do the real pre-seed is really true pre-seed is idea founder, and that's where I like to personally invest. But most institutional, I think we should, instead of looking at it from stage, we should look at it from dollar check investor, right? So angel investor. A true angel investor. I'm an institutional investor. I'm a solo capitalist, as they would call it, right? So I have LPs that I'm investing other people's money for, in addition to my own. But I'm a solo capitalist. A true angel is somebody that can write a 25 to 100K to 250K check just because they like you, and just because they hope that it works, and if not, they get a tax loss against their other stuff. That's an angel, and that most people need angels before they're going to get a early stage institutional investor. Anybody that's investing other people's money, including most solo capitalists, what they're looking for is either a team, not just one person, but like a person and one or more people that are already attached to that thing. And they're looking for, obviously a big market and, ideally some anecdotal evidence that it could work. And then, but most institutional investors are not, even if they say that they invest at pre-seed and seed, are not going to invest in you unless they already know you, or unless you have some kind of network that they can reference that they can rely on, right? So most people, even though they see seed stage and idea stage things in their portfolio, that's because there was already that network that they could bet on the team. And if you're not in that network, you're not going to get their capital until you have taken an angel or a pre-seed fund and proven something. Most institutional seed investors or even pre-seed investors, they're really investing when you've got 50K, 30 to 50K of MRR in most businesses, or the beginnings of a scalable revenue model.
Do you think what's the problem if you take an A investor at the pre-seed?
Oh, I mean, an A investor at any other stage than A is.
Well, sorry, let's clarify. What do we think A means? It's like
I would
third
say
round of money. How about that?
It's really when I say A, I mean actually a fund that has $500 million or more of assets under management, which is where typically they are trying to get their 15 to 20% for a $10 million check at the Series A. But instead, they like you so much and they like this idea that they say, why don't we do like a $5 million seed round with you? We'll do your seed round. Greylock just announced an entire seed vehicle, $500 million. A16 has their seed vehicle. Almost all of the big multi-stage funds now have a dedicated seed vehicle. That's the worst investor to take money from. The worst investor to take money from, because when they don't do your Series A, when they don't immediately preempt their own round, they're saying to the rest of the world, we know this company better than you do. And we elected not to, put all of our chips in behind this idea because, for whatever reason. And those companies can have the hardest time raising follow-on capital, and many of them actually die after the seed, even though they ought not to.
So if I'm a founder and I've heard about you and I'm like, hey, I really want to work with Tom.
Yeah.
How do they find you? What do you think the right strategy is for reaching the sort of early, somewhere in between seed or pre-seed and seed investor?
I'm unique in that I will literally, I'm one of the few people, I'm just trying to get my battery in here, that reads my LinkedIn, email, right? Like I read, if you cold email me, because I've been that entrepreneur, I read everything. I don't reply to everything, but I read everything. In general, though, I think that, and most early stage investors are discoverable, that they want to be found. But I would say that the most important thing is not how to contact me or any particular investor. How do you find the right investor? Because what I find happens all the time is that, somebody's making a cold email to me when, if they had just done a little bit of research, they would know that I'm not even a potential prospect for them, right? So how do we do that? First and foremost, looking at, existing companies that you consider to be, at least in your industry or business model, and just simply looking at finding those companies, looking at the years in which they were founded, looking either on AngelList and or Crunchbase for, who the investors are that are credited to that company. Just doing that actual work is what so few entrepreneurs even go and do, right? And so the other part of it is that if I was a less generous investor, right, what I am looking at is this person just scattershotting, or is this person actually thoughtful in why they want to, like the art of the cold email? It's just such an important, part of all of this. And And so it's like, oh, the fact that you were an entrepreneur, selling into HR software, I'm doing this HR thing. I'd love some advice from you, that kind of thing, right?
So an inbound from MailChimp, not so much.
Right, exactly. The unsubscribe link on the bottom.
Hey, did you, that's like the best life hack I learned today, which is you set up a Google Gmail filter for the word unsubscribe and just jam that in the trash. And I was like, this is so life-changing.
The other thing to do is, if you're trying to find an if you're trying to find a particular investor that you want to get in touch with, the one thing to do is to really go to their portfolio CEOs and say, hey, I'm raising money. I'm thinking about raising money from so-and-so. Would you be willing to give me like 10, 15 minutes to tell me, kind of, who on your cap table was really helpful, and help kind of just, give me a little bit of feedback on my pitch. Because we, as entrepreneurs, we've all been in the fundraise. We're all willing to help another entrepreneur if we've got a few minutes.
Sequoia pitch deck format, yay, nay?
I don't even know the Sequoia pitch deck.
9 slides of pure bliss. All right, I'm sending it to you as a Christmas present. Oh,
look, I think you definitely need a deck, right? I mean, I will not I will not take a meeting without a deck, because if you want to waste your time and my time on something that you have not established I'm a good fit for, right? Like, why are you wasting your time or my time? I don't care about really my time as much as I do. Why, as an entrepreneur, are you not prioritizing the right people and being targeted in your approach? That to me is like an automatic kind of red flag.
I agree. I found lots of folks reaching out in general saying, have this really cool idea. And what I find hardest to distinguish in FinTech, because I'm so deep in it, and you do a bunch of industries, is why is this particular idea a slight variation or got a more probable chance to succeed versus the 10 others that are in the same category? And I'm curious, like, how do you think about what's the X factor? What is it that you go for when you're doing this?
Well, I mean, for me, it's all about people. And I don't mean people, from a particular school or whatever. I mean, I believe I can read people and I can assess people better than almost anybody. And so for me, it's a people game. Even into the later stages of companies, it really is about, people and why they're doing it and so on. But I'm not like most investors. I think institutional investors, for the most part, if they decide that your idea is something that they would consider funding, the first thing that they or their team does is they go and they meet with every other company that is doing something like this. And that's what a lot of entrepreneurs are upset when they find out that a VC who's expressed interest in them has now started to meet with all their competitors. And honestly, I was that type of entrepreneur. I'd be so, like, what are you doing? Just getting in information. But if you think about the way that they look at it, they want to make sure that they're backing the right horse. And that if the market is something that they now know a new entrant is going to become a massive company, they don't want to make the wrong bet. And so they will meet. And a former partner from one of the most name brand funds in the world said to me that, what would often happen is that they would have the entrepreneur talk about their competitors, and they would each basically say, oh, they don't do that. Meanwhile, the next guy would come along and say, oh, no, they don't do that. And so, a poor understanding of your competitive landscape is something that will put cold water on an otherwise really big desire to invest, right? So
you're in that pitch to partner meeting on the Monday, because they're always on Mondays, apparently. Tuesdays sometimes now, but Mondays. And you get this question you just literally don't know the answer to. Do you say I don't know?
I don't know.
Yeah.
That's a really interesting perspective. I hadn't thought about, the reason for that question. It's not something because we're focused over here right now, and we're so focused on that, I hadn't really stopped to consider that. Thank you for that. Let me get back to you, because it really does deserve our consideration right now. I'd love to send you a follow-up message on that. That's the best kind of, the best kind of thing. The worst kind of thing, again, that can throw cold water on what would otherwise be a term sheet is exactly that. You filibustering a question that you just think you have to answer because you have to have an answer for everything. That's a great.
Who do you think does the pitch?
What's that?
Is it the founder or the CEO does it and brings the
Yeah,
team, or they by themselves?
I don't, unless you have a co-founder who's going to shine as bright as you in a particular area that is really important to the consideration of the investment. I think the CEO should always just do it themselves. When you bring another person in the room, if they are not as engaging and as charismatic and as complete of a picture as you're presenting, that can also undermine an otherwise great pitch.
Do you think all founders should be on 4-year, 1-year cliff type of vesting schedules?
Absolutely. Absolutely. I mean, in my pre-seed portfolio last year, at pre-seed, we got rid of we had 2 co-founder divorces in the first year. And I predicted both of them. And I was upfront. I said, like, I don't think that this is going to work, but like my job is to give you all the, the hope and desire to make it work. But, co-founder divorces are good and healthy if you have proper vesting agreements and if you have good, honest conversations. I also don't believe in any way that most co-founders should be 50-50. There's a great thing called Founders Calculator, and it literally plugs in, what are your roles and responsibilities? Who's doing what? Are you full-time? Are you part-time, et cetera, et cetera? And it will give you what they suggest to be that. I think the problem with most co-founder dynamics is that one person had the idea and the passion and the willingness to just bust through every wall, and the other person is their buddy that they convinced to come along with them. And the buddy can contribute all kinds of things, but isn't as passionate about the thing. And so, and just is not going to put the same, I've seen it happen, but I'm saying in 100+ investments, I've rarely seen it, where both co-founders are kind of truly deserving of that 50-50. And
so no co-CEOs then?
Oh God, co-CEOs are the worst, right? There's, one decision maker. And the other part of it is there should also be no titles. Under 20 people, there should be the CEO and a team around that person. That's it. Yeah.
Do you think who's going to be more successful, solo founder or a person with co-founders?
Now this is a controversial opinion. I believe solo founders are way better than co-founders. Because again, passion, drive, that kind of thing. A lot of institutional investors, I think very wrongly, will look at somebody as most solo founders have a harder time raising capital absent just a kick butt team. But I think in the long run, you're better off being a solo founder and building that great team around you. That's what I try to make almost every one of my pre-seed investments with solo founders, that then we can go and build a great team around that person.
So it feels like another attribute that you could put into your matrix of what's my right investor. Because if you're a team with 5 co-founders, maybe they just shouldn't even call you, type of thing.
Yeah, and that's the thing is that what you'll find is that almost every investor, especially investors who, I was just telling this to my wife and partner of 20 years just the other day. I said, I'll really admit this because it's, in the Synctera family. I said, I'm kind of becoming that investor that as an angel, I hated talking to, because it's like, I just looked at an entire accelerator batch. It took me 5 minutes and I was like, no, that won't work, or that, and it's because once you get to a certain degree of success, you know exactly what you're looking for. You know the type of entrepreneur that you want to work with and so on. And so you become really good at saying no. And also back to
do you end up saying no more to the idea and the product or to the team?
No, it's almost all, it's never, I mean, I would never judge a person that I haven't met, right? It's all like, I've seen this exact attempt, right? Like in, for FinTech, all of these credit books, right? All of these guys who think that they can build the SaaS tool that is then gonna, underwrite all this, magic, debt stuff. It's like, man, you have no idea how hard a credit book is operationally. And so when I see that kind of thing where there's just like, like there's the dot at the beginning and the dot at their $1 billion credit book, but they have no idea about what's in between those two things. It's like, no, sorry, that's not, we just can't do that. But
so that's actually a really interesting part about FinTech, because FinTech's one category where there's so many people you could partner with to help you bring your idea to light, or you could try and build it all yourself. Where do you, when you're looking at investing in, I don't know, the next green light startup for kids, for example, how much do you think about the go-to-market, the product marketing and all of that side, and the community versus the platform and the tech stack at pre-seed?
I think any investor that's talking about the tech stack for a pre-seed is like, and that, but like, while we're talking about this, your point about me not, I'm not the guy to talk to if you're a 5 co-founder team with 5 co-CEOs, that notion of it not being a hurtful or bad thing that an investor is like, hey, I really need, co-founders, and that's that's just their idiosyncrasies. It's not something that you should over-index feedback to, right? You should do, you should do you the way that that you do you best, and investors should do them the way that they do it, and like just find that perfect compatibility. But yeah, I mean, any investor, and there's so many bad investors, as you and I both know, that are just, asking the wrong things at the early stage. Like the implementation details do not matter in any way at pre-seed and really seed. What matters is, can you capture the customer and retain the customer, whether retain in a, like, not even in a real retention sense, like, can you get their attention long enough for them to actually do one thing with you? Like, that's just so hard, right? And can you do that in a repeatable process? That's the hardest part. And I'd also say that because there's so many engineer-oriented investors, particularly in the Valley, they over-index to what they know, and they start asking you all these kinds of questions. Frankly, I think the most valued part of the entire ecosystem in venture investing is marketing. Like, especially in SaaS, the ability to get your message crystallized and reinforced credibly to your audience. That's such an art. And it's the driver to most of your customer adoption.
Yeah, and I think for us at Synctera, we were super lucky because we had some crazy founders that had a bit of street cred. And so we got away with having not the best marketing. Like, our website, it's okay, but it's not that great. And we haven't done a whole lot of effort to actually outbound communicate. All of that's starting now. The interesting thing about not doing marketing is you get the customers that find you as opposed to the customers that you look for.
Right.
And when you're doing SaaS or enterprise stuff like us, the customers that find you will be across every range of different use cases. So by definition, we had to build a whole bunch of stuff to satisfy each individual fintech. Whereas if I just said, all I want is student fintechs, divine me a marketing campaign, and we got 10 of them, then we could do all of those features, and then we'd go on to pet store fintechs.
Yeah, and that's the hard part about being a real platform, right? Like, you're not going to get platform cred by being verticalized and serving, only a certain segment, right? You do have to kind of describe multiple use cases. And by the way, that's something that, if my advice to many startups, anything in SaaS particularly, is, make a website like you have 10 verticals, right? And just look at heat maps as people are discovering you, what are the use cases and what are those verticals where, and like, I would overbuild the website before I built the product is kind of what I'm saying, right? In anything that's SaaS, anything that's customer decision oriented, I think overbuilding the website before the product is probably a good idea.
We're sort of hacking that by doing microsites. So we're doing 10, 15 LinkedIn, Facebook ad campaigns for, are you this type of fintech, that type of fintech? And you land on a page, which is really just the one giant page that says, did you ever know about healthcare fintech? Here's everything you needed to know.
Right.
And you can't get back to that content on the website. It's just like a microsite. But as long as we get the intention, we can figure out which one's landing more and invest more.
Yeah.
What do you think? How much money should someone raise?
Not too much, not too little. I think what you at pre-seed, you, especially if you need 3 to 5 people to quit their, getting people to join your team at the earliest stages is really hard to do under, $1 million, and so, you're also salaries, at least in North America, have gone up so significantly. And I think wage inflation in our industry is deservedly has increased such that, I typically like to write smaller checks because I know how to do a lot with a little, right? But generally speaking, I'd say, a minimum of, $500,000, and is with $500,000, that you have to be raising more capital very quickly after that $500,000 is burned, or generally, $1 million at pre-seed, or generally, $2 or $3 million in a seed round. I think when you're a first-time founder, raising more than $2 or $3 million is a real, even if it's on offer, I think it just develops really bad habits. Capital scarcity and doing a lot with a little is it's the best skill that a founder can develop. But then there are certain businesses, out not in FinTech as much, but there are certain businesses that just, the capital is the capital. You need $8 million before there's any proof points.
Hardware, right? Don't even talk, right?
Yeah, and there are aspects of FinTech where if you don't have a balance sheet, after you've got your payroll covered, if you don't have $1 million or $2 million bucks, on top of that, nobody's going to take you seriously. Or you're doing a lending business where you have to start off your balance sheet. Certain businesses just require more capital, and that's okay. And I'm not a business plan, person by any means, but I do think that if you are looking for more than $1 million, having, a reasonable financial set of assumptions is a really important part, because it shows that somebody has thought through how they're spending this money or how they propose to spend this money versus just winging it.
Yeah. Do you think that there's a challenge that the first-time founder faces, which is, I talked to 100 VCs, they all said no, I've been doing this on my own dime for 3 months. How do they decide the idea isn't working?
Yeah, that's a great question. And I'd say that if you're looking for validation from VCs, right, or if your primary market validation is VCs, then you are you're doing it all wrong, right? VCs are not there to validate your business. Your customers are there to validate your business. Mm-hmm. And if you're going into a fundraise without the ability to definitively point to some form of validation, and you're asking VCs to deem your idea worthy enough, the chances of you achieving that is very, very, very low, especially if you're not known to them. If somebody has to take a leap on a new idea being a big enough market, they're only going to do it with people that they already know in their network. They're not going to do it with somebody new.
Yeah.
So I think if you're needing this podcast, this series before you go out to fundraise, it means you're somebody like me, like somebody that had to build their own network, and you need to start those conversations with this is why this is going to work. Look
Yeah.
at the evidence that I have as to why this is going to work, even if it's anecdotal.
And when you're 6 months in, your pre-seed is running thin, and you realize it's not working, how do you tell the team you're pivoting, or what do you do? What have you? Do you tell the investors? Do you just pivot and then see what happens?
No,
with the
I think
change?
you tell somebody like me, like the friend of the entrepreneur, but you never tell your investors that you yourself lack, credit, like lack faith in where you're going. And I think that's even something that you should be very, very careful about with your team. I think the one thing that can mitigate all that is not being massively declarative from the very beginning, right? To say, hey, we have this direction that right now we know is actually there's 615, don't judge me on my math here, but like anecdotally there's 615-degree paths in front of us. And what we're going to do is we're going to walk down one, and we're going to see if there's any boulders in front of it. And if the boulders are pretty small, then maybe we can traverse it and maybe push them aside or whatever. But if they're too big, we're going to walk back to the beginning, and we're going to go to the second 15-degree turn and do that same thing. Whereas, because if it's just one thing, like, then I don't know, there's probably something wrong about, like, there's almost never just one way to attack a market. But if you are, I think entrepreneurs who say to them, to their investors, look, you know what, I've explored all avenues. There's a little bit of capital left. I'm offering, I don't think that anything in what we've been looking at doing in any of these areas is going to work. And here's why. I could offer to return you the capital, or if my team's willing to take another shot, like being, choosing when to have really frank and honest conversations with your investors. Your investors believe in you, and they've also stuck their money with you. They'd in most cases rather see you try until the very end than return, partial capital back. I think that's worse than, partial capital back is definitely the worst outcome,
Yeah. Last question, and thanks so much for your time today. What do you think, what's your message to that first-time founder? Go for it, like, bet the farm, or be cautious?
It all comes down to, if you've got, I think one of the problems is, many, whether you're an immigrant and, you're dealing with, even though you're in your late 20s, early 30s, your parents and what they say matters a lot to you. You've got a relationship, you're living with that person, or you're married, whatever the case may be. There's so many dynamics where you might only have one shot, right? And so knowing when to shoot your shot, and whether you're really prepared to do that is something that I wish way more people spent time on, like just like mentally and emotionally and spiritually. I'd say that's a big part of it. And knowing that, like, because imagine being, 70 and having had to stay working for the bank, and knowing that if you'd only waited an extra year, right, like that could have been your shot. I think that'd be hellish. So I think knowing when to shoot your shot is really, really important. It's something that people don't spend enough time on. I think the other part of it is, in terms of going out for capital and other investors' money, you really ought to have exhausted, every, friend and family member and credit card and everything like that. I think right now we're kind of getting back into that mindset of, oh, I've got an idea, and while I'm still at my job, I can, raise capital. And it's kind of feeling like some parts of the 90s again. And that didn't work out that well. And there's a reason for that, right? And so, even having to convince your friend or your family member that this is a good enough idea, it's a gate, right? It's a validation gate, right? And so I think the more validation gates, it's also using that gate analogy, it's also a form of calisthenics. It's going to make you tougher and tougher and better that you've convinced a lot more people that frankly know you and should believe in you. And if you can't convince those people, like listen to their feedback. Like don't just go on to the next person and go, F that person, they're not with me. Like learn from that, understand what's, maybe you're not, like I just had a founder of mine and who came to me and said, you know what? We've got a real problem. I've already funded this founder, but like everybody that I ask, what am I working on? Nobody can give me like a straight, quick answer for, and it's like disjointed. And so she's like, okay, well, I've got a problem here with, with storytelling, and I need to go back to the drawing board. Like, that kind of feedback loop is extremely important to strengthening you.
Awesome. Hey, Tom, thanks. You are, without question, my most cherished investor and friend and colleague and ass kicker when I need it. Thank you. And thanks for your time today.
Yeah. And Synctera family, I'm definitely, I will read every cold email, LinkedIn, et cetera, and always happy to help wherever I can.
Awesome. Thanks, man.
Thanks. Bye for